There's a long way to go in this month, and October has always been the month that you worry about major moves happening because of the way managers position themselves going into, in the start of the fourth quarter because they want to lock in their gains for the year. And so we've seen this time after time after time. The fact is that, as long as consumers are buying stuff, admittedly, they're doing it on credit. Yields coming down might actually be helpful for them. So, it's a really interesting scenario, David.
How will the Fed react to the latest economic data? We'll be talking about macro and the ongoing Sam Bankman-Fried trial with our next guest, Dave Weisberger, co-founder and CEO of CoinRoutes. Shout out to our sponsor today, iTrust Capital, an IRA that offers 35 crypto assets in physical gold and silver. iTrust offers 1% trading fees, the lowest in the crypto IRA space. So if you're over 18, want to open a new account with cash or roll over an existing IRA account, click on itrust.capital/David to learn more and get started. Link down in the description below. Dave, welcome back to the show.
Nice to be back, David. Always a pleasure.
A lot of hot topics to discuss today. Let's start with the economy. Jobs numbers came in rather stronger than expected. Stocks are up, bond yields are up, bonds traded down, sold off. What's your read on this? I mean, why are markets reacting the way that it is? It looks like a risk-on play, the way that things are progressing from here. I'm looking at my screen green across the screen. Why is it that markets are reacting the way they are?
I mean, look, my normal gut reaction is generally the knee-jerk reaction to most economic data is wrong. But the fact of the matter is, the overwhelming amount of bearishness and people expecting a crash in October is high. And as a contrarian in general, I think that basically what you have is in this case, a buy the news event sort of deal. Bonds selling off is actually bad for the market, but the truth of the matter is that the stock market is like, well, where else are you putting your money? And so that it becomes more of an allocation play. As long as new money isn't coming in, or new money or money isn't being liquidated and moved to cash, then a play where bonds sell off and people move into stocks because they say, well, the economy is doing better than expected. It's not that crazy, but there's a long way to go in this month, and October has always been the month that you worry about major moves happening because of the way managers position themselves going into, in the start of the fourth quarter because they want to lock in their gains for the year. And so we've seen this time after time after time. The fact is that, as long as consumers are buying stuff, admittedly, they're doing it on credit. Yields coming down might actually be helpful for them. So, it's a really interesting scenario, David. I personally, I understand the bearish arguments on the broader market, and I'm a little bit cautious myself, but I don't like crowded trades. Crowded trades always concern me, and I always give people advice that if you're following the entirety of the herd because you hear everybody is doing X, probably X is not the right thing to do. So I don't really have a strong opinion on the risk on, risk off. But what I can say is that we are seeing literal perfect storm conditions for Bitcoin. I mean, Bitcoin is at its core a play against, it's a hedge against the trusted institutions. And between what's going on in Congress, what's going on in the yield curve, what's going on the macro side, I think Bitcoin is very undervalued, and people talk about the halvening. It's not even about that, although it will certainly be that as we move a year from now. Certainly, as we get past it into what goes on. But I do believe that Bitcoin itself is in a very interesting situation. And while it's too early to say it's demonetizing gold already, the fact is there are certain baby steps towards that. So I've been on bunches of macro podcasts and Twitter spaces where I've made this point. I think that I wouldn't want to be short Bitcoin. If you want to be short overvalued, stocks in the S&P sectors that their price to sales or the yield is dramatically low, the earnings yield is dramatically lower than bond yields. Okay, I guess I can see that, but it really is an interesting macro trade.
But okay, Bitcoin is what for you? A risk on or risk off play
Well,
fundamentally?
long term, it's a risk off play with enormous asymmetric upside. Short term, It has historically been a risk on play because the speculative money is what gets the movements either way. What we've seen over the last 6 months, though, is every time the speculators move in, the immediate speculation fades, and we get back to this kind of very gently upwards and to the right sloping kind of environment where you have more long-term buyers buying it, and that's why you see more off exchanges. That's why you see the long-term holders or hodlers, depending on how you want to phrase it, going up and to the right as well. And frankly, as long as there is supply and they can get it, they're happy. But it seems like that up and to the right is happening because there just isn't that many natural sellers because the percentage of long-term holders keeps going up. And so at some point there's a race. There just isn't enough supply to satisfy anything close to a 2% allocation among standard typical portfolios, which is really starting to gain a lot of traction with a lot of people. And so we'll see how that happens.
So the exact number for from today, non-farm payrolls increased by 336,000 for the month. That's better than the consensus estimation for or estimate for 170,000. This is the largest single month increase since January. You're talking about crowded trades and people being bearish. Is this? I know one number doesn't make a trend, but is today's report changing people's minds on bearish sentiment?
I doubt it changes their minds, but I think if you're a trader and you're expecting to see bad earnings and you see a number like this, you have to say, ruh-roh, and you might want to lighten up those short positions. And that can easily create the kind of market dynamics you've seen today. Because when you see a surprise like that, when you see hiring like that, hiring doesn't happen where companies are losing money. So if earnings estimates are exceeded, markets will go higher. It's just that simple. And I'm not saying that this is proof of that. And I certainly never want to interpret anything I say as investment advice. But what I will say is traders going into a weekend, seeing news that sorts of dispels their thesis will tend to flatten out. And I think that a lot of professional traders were leaning short.
The Fed is certainly looking at this data. Just this morning, the CME Fed Watch tool is now projecting a 29.3% chance of one hike by November. This is a big jump from what it was just a few days ago. And I think the rest of the months later on, towards the end of the year and later next year, aren't changed. Do you think then, my question is, do you think the Fed will hike once more on Straub jobs numbers?
I think that depending on what comes in on the inflation numbers when we get them, when the PCE inflation is clear before in the last reading before, if they are well over their target, they will hike in November. I think that Powell has to be literally grinding his teeth down to the gums by the things the administration is saying. I mean, one of the pieces of news that has not been terribly strongly reported, but I can't believe it because it's a huge deal, is the fact that Elizabeth Warren, who's the most powerful person in this administration in charge of not just this in the Senate, but also having been given the ability to appoint her acolytes to the administration throughout all the various agencies, came out on X and posted how bad it was the Fed is raising rates and how it's hurting people, at the same time that the administration and frankly both presidential challengers have been cheerleading the UAW to get more wage raises. That's kind of a big deal because Fed, Chairman Powell is clearly someone who cares about inflationary expectations. Whether he's a dyed-in-the-wool monetarist or not, he clearly manages inflation expectations. And so we have a situation where the Fed is more and more being isolated by the administration alone in its fight against inflation. That could go one of two ways, David. Either one, he could throw in the towel and say, well, if they're not going to help, what's the point? Or two, he could just dig in even more and say, well, I need to raise rates again because look what you guys are doing. And I would vote at least one more time on the latter. But I do think at some point, if something breaks in the economy, then he'll be forced the other way. But this jobs number probably gives him more comfort that he could get away with trying to push against inflation. So that's true. But then you have to ask yourself a question. Does a quarter point really matter? And what assets does it matter to? And I think that's a large part of what you're seeing. People are saying, well, if it hasn't mattered so far, if the recession that we've all said was going to happen, and come on, how many analysts have you seen say the inverted yield curve 100 out of 100 times it's a recession, and we haven't seen it, right? So at a certain point, you have to ask yourself the question, if you're an investor, is, well, do I believe this is happening? And I'm not saying it's not going to happen, but I am saying that the certainty to which people have predicted we would be in a recession already is it's a crazy number. Virtually everybody on the macro side has been predicting we'd be in a recession by October, by now, right? And I've been saying it for 6 to 9 months. I don't know how many of your guests have said it, but I'd guess dozens.
Yeah, it's not. It's not just you and my guess. It's Wall Street firms are now projecting recession by next year. They're pushing it out. They were saying it by next by this summer. I think the point is, and we'll move on to crypto. I think the point is, it's not so much what is happening now; it's perception of what may happen later. And so the Fed investors are all looking at economic data, making a forecast in terms of what may happen into Q1 2024. What do you think is going to happen to the economy Q1 2024? We're all just prognosticating here.
I mean, look, I think a few things. I think that the banking sector is in deep trouble. I mean, the stock indexes on the banking index are, plumbing lows that really look like there's already a catastrophe, and we haven't seen one. I think that there are many areas of finance which are seizing up. Commercial real estate being an obvious one, but there are others. I think that you have a housing market where we are structurally short housing in America, and nobody is willing to sell their house because they're locked in at rates like my rate, 3.25% on my condo. No, I have no interest in selling. I love Miami, and I'm not going anywhere. But the truth is that when you have so many people who are locked in at rates because everyone refinanced down at the bottom, that the supply of new homes, of existing homes, is just there just isn't any. And so these are interesting situations that are going on throughout the economy. But at the same time, when you talk about non-interest rate sensitive or not very interest rate sensitive sectors, which is most of them, the fact is interest rates at these levels is far from abnormal. I mean, I'm old enough to remember that 5 to 8% was sort of where it bounced for decades before we got into the zero interest rate environment after the internet bubble, after the world global financial crisis. Before that, this range is nothing crazy. So it's not like it has to stop the real economy. It does, however, have a tendency to curb speculative excesses. And there are a lot of people in the government who are looking at this and saying, well, we kind of need speculative excess because we want more investment in automation, because we need to improve productivity, we need to improve growth, yada, yada. And so you see all these cross currents. Last cross current, David, you mentioned first quarter of next year. Going into a presidential election, do we really believe that this administration is going to allow a Federal Reserve to trigger and tip us into a recession? Every time there's been a recession, even mild ones during a presidential election, it tilts the election. I mean, Clinton beat Bush, and someone gave a talk about this at a conference I was at yesterday. Clinton beat Bush largely because of Greenspan raising rates into that election cycle. And people there watching this. So we'll see what happens. But I've said all along that if we survive into the actual presidential election cycle, that the Fed is going to ease off coming into that because they're not going to want to be seen of influencing it. And that in and of itself is a big deal.
I've heard that argument before. The underlying assumption to that statement, which is that pre-election years or even election years are good for markets or good for the economy. The underlying assumption here is that the Fed and Congress and perhaps even the Treasury collectively have a hand to play in controlling the economy. I don't want to use the word control. I don't think they're controlling it, but influencing the economy. We're not just letting the invisible hand of competition of markets do their own thing. The government has some sort of influence. Is that true?
I mean, I think that Japan is your archetype here, where they've had to manage their yield curve, with 200+% debt to GDP, and they've done purely yield curve control so that their JGBs would be basically below 1% for years. People like to think the U.S. is a free market, but the freedom of our market is definitely questioned, at least somewhat. We'll see. I think the bottom line is influence is there for sure. Control is not there, nor do I think that that's particularly a politically tenable thing. So somewhere on that continuum is where we are. But I think if you're asking the question, is there likely to be more, if not accommodation, less of a strict monetary policy to try that design is to curb aggregate demand. I think that that is highly likely going into a presidential year. It's not really about influence. It's about, okay, maybe we should influence it less. And we'll see what happens. But I tend to believe that politics and human nature win out in the end. And so I would be surprised to see a strong or deep recession without the Fed panicking and going back to QE. Now, I've said the other thing I've said multiple times is that watch what both hands are doing. They may continue to raise rates slightly, but they might also start buying bonds again. Just like, don't be surprised to see more releases from the Strategic Petroleum Reserve accelerating into next year to bring down the price of oil as you go into an election season as well. And I think that one of the reasons that you've seen that pace slow and, if anything, kind of ebb back to up in the other direction is because they want to save their powder for when they need it. And oil prices filter through the economy very strongly and are generally underestimated as a contributor to inflation. Even when you exclude energy, energy filters into everything else or many other things.
I like talking markets with you because before you started working in the crypto industry, you had a long career working in TradFi, having held senior positions at Citigroup, Salomon Smith Barney, and also Morgan Stanley. So you're well equipped to talk about both TradFi and crypto. Now being the CEO of CoinRoutes, we'll talk about CoinRoutes in just a bit. Let's switch gears into crypto. Now, the biggest news item this week that's capturing everyone's attention is the SBF trial. It just started. Prosecutors are claiming that he has, this is probably the biggest financial fraud case in U.S. history. They're claiming that the 31-year-old ran the world's biggest crypto exchange, stealing billions from customers and investors, all kinds of accusations going down. Before we begin and talk about the trial itself and some of the more out there claims, why do we care about this? It's a bigger question. What impact does this have on anyone else's life?
Well, it's a very big deal because last November, on November 1st of, not even a year ago, FTX was the number one platform for professional investors, particularly in the West. So like our customers, CoinRoutes, we had over 15 clients go bankrupt because they lost their money on FTX and they had to return money to shareholders. They were performance-based funds. Our clients tend to be very skewed toward quantitative and proprietary firms because we deliver best execution. That sounds really interesting, but most people in retail don't care. But if you're a proprietary trader, you care a lot because every dollar you save trading goes directly to your bottom line. And so all of our performance-based managers who lost money there it became impossible for them to make their hurdle rates. Let me explain. So let's say you are a manager that gets 20% of the upside, and we had one manager who was averaging, mind you, David, over the previous 12 months, 8% per month in returns with a Sharpe ratio, which is a risk-adjusted return ratio that was quite good. You don't need the specific numbers. They had 55% of their collateral parked at FTX, and it went boom. And to make up that would have required over a year and a half of the same returns, which meant they had to not pay their staff for a year and a half. Of course, staff doesn't like not being paid for a year and a half. So what did they do? They were going to leave. So they basically said, we got to shut the fund. And that happened all over the place. So that was a very big deal. Second very big deal is we all know that SBF and FTX were the largest single contributor to political campaigns. It's more explicit on the Democrat side, but they were big on both sides. And so they had an enormously high profile in Washington, D.C. So now you have people who, Maxine Waters quite famously early in the FTX case thanked Sam for his candor, literally, after it was pretty clear that something really bad had happened. So that was true. So now those very same people who took that money are now burned by it and saying, now we can't have any crypto regulation. We can't, we have to hate it. And so Elizabeth Warren famously came out and made arguably the biggest political mistake she's made by actually creating the notion that she headed up the anti-crypto army. But that's all an aftermath to FTX. So it is extraordinarily important for people to understand that this isn't systemic to crypto, that this is as systemic to crypto as Bernie Madoff is to equity asset management. And frankly, nobody looked at Madoff and said, oh, I can't trust asset managers. I can't trust the equity markets. They said this guy was a thief and a pathological liar and a sociopath. And so the market moved on. Well, it's really important for people to see that SBF is a pathological liar, a sociopath, so the market can move on.
How come, okay, the largest crypto exchange in the world, most influential for a lot of the reasons you just mentioned, how is it that nobody saw what they were doing until it blew up? You're saying the auditors, the prosecutors, well, not prosecutors yet, but the regulators, the his clients, his business associates, they were all asleep at the wheel?
No. The auditors, if they had them, would have seen it immediately, but they didn't. Their investors did no due diligence and frankly are a stain on the entire notion of investors. I mean, the person responsible, Sequoia, is long gone, but a dirty little secret in Silicon Valley is many of the largest investors put their faith in founders and don't dig into details. That's really a bad idea, right? I laughed at the time because it was true that a company like CoinRoutes, we have 30 people. We are far more buttoned up in terms of auditors. And by the way, we don't touch client funds at all. We are a pure software company, and we are much more buttoned up than SBF was. So auditors weren't even in the picture. Investors weren't doing due diligence. The people in the company, as you're finding out in the trial, all knew what was going on, and they're all turning state's evidence to testify. Clients had no way of knowing really what was happening because FTX did operate a good business. Now, I put the quotes around that because Michael Lewis makes this whole thing that FTX is a great business. Well, it was. It made hundreds of millions a year. Didn't make billions, made hundreds of millions a year in fees. But they spent more than that just in marketing and advertising and political donations. And no one really thought to ask where the money came from. Everyone was told it came from Alameda, that they were an incredibly profitable hedge fund, but they weren't. In fact, they were losing money. And so what they were doing is, as they were losing money and making bets, they were giving themselves collateral from a coin they created out of thin air called FTT and another one called Serum. And should never have been considered good collateral. And so it got bigger. That hole got bigger. They tried to raise money. They didn't quite succeed. The hole got bigger. They tried to raise money again. Still didn't get there. The hole got bigger. And eventually they realized they couldn't raise that much money, so they wanted to let Binance try to buy them out. You might remember that at the end. And Binance, when they finally got in and looked, said, okay, wait a minute, the hole's too big. But if you look at the business, what you see is a very clear picture of a trading firm more or less doing the same strategy that kills too many gamblers. Bet on black and roulette, or bet on don't pass or pass and craps. And then if you lose, double down. And if you lose again, double down. And eventually there'll be a streak bad enough that you don't have enough money to double down again. And that's what happened to them. It was a clear case of gambling, but it's overlaid by this notion that a good business, which could never have afforded to put names on stadiums, patches on every umpire in Major League Baseball, the largest donor to the political system. I mean, they basically were spending more money on marketing and political donations than companies 10x their size. Apple and Google and Microsoft, they were outspending them to create the illusion of grandeur, the illusion of safety, the illusion of influence. And that was a large part. So you had both of those things happening at the same time. That's why this case is so important, because that narrative needs to be said. People need to understand the importance of actual audits, the importance of actual clear delineation of customer funds versus proprietary funds. Those are very important. And this is showing that, and ultimately will show that over the next 6 weeks, however long the case lasts.
Yeah, that and the fact that I think they were using QuickBooks at one point to do their accounting as a multi-billion-dollar company. So the question is, should we have companies disclose, or exchanges in particular, disclose their financial statements to the public, even if they're not publicly traded entities? Should we change that?
Well, I mean, look, at the end of the day, in every other type of financial asset class where there's clear regulation, they don't have to disclose the financial statements to the public, but they do have regulators who are looking over where customer funds are, how they're segregated, how they're reported, how they are handled. And that is a good thing. And give credit where credit is due. Brian Armstrong at Coinbase has been saying this very loudly for a very long time now. That's why he says he wants regulation. He doesn't want stupid regulation, but having a regulator certify so that people know what he's saying is true is a good thing. That's why exchanges like OKX have hooked up or have a deal with Copper with a thing called ClearLoop to segregate customer assets separately, and other exchanges are joining suit now. So the industry kind of knows that this is true, but until the investing public, until they know that there's a cop on the beat, or at least somebody who can do something about this, there's a little bit of reticence there, and that's why there's a lot of things that has fed into.
All right, well, let's talk about SBF himself. This is an article from BBC. Let's get your take on what may happen to Sam. So, according to this BBC article, analysts said the odds of winning favor the government, which has an overwhelming record in cases like this. They quoted a Columbia Law School professor. He said that, "I don't hear a strong defense that Sam has created yet. He may convince people he's kind of a bumbling fool, but that's not really a defense that will work very well when there are all these people testifying against him." What's your take on this?
I mean, I think that the only thing I can think of is between Michael Lewis's absolutely ridiculous grandstanding appearance on 60 Minutes and the book that I haven't read and really don't want to contribute to Michael Lewis to buy and read, is to try to gain sympathy and perhaps to angle for a pardon or a reduced sentence on the basis of some sort of sympathy, like, oh, well, he was just trying to do good kind of defense. I hope that can't work. I mean, in my mind, he is a low-grade Bond villain who tried an audacious scam to spend more money than he was making in his business on self-promotion, on advertising, on political donations, on hobnobbing with celebrities. I mean, I'm not going to lie, I enjoyed the FTX conference because I got to watch Bill Clinton and Tony Blair and Tom Brady talk to us. It was very interesting. But there's simply no way the size of his actual business justified any of that. And so this is not somebody who was bumbling. This was clearly a goal. I mean, I did a podcast one-on-one with him a year ago, July. I then went back and listened to it, and there are multiple statements he made in there, and actually published a blog post about this called The Bizarro World of Sam Bankman-Fried. You could look it up. The fact is that there were multiple statements he made in there, which if repeated in this trial, would be damning to him. Things that he understood how important it was to segregate customer collateral. He actually said that. He claimed he was doing it. Now, it's one thing to be unaware of the impact of various details, but you cannot, as a CEO, be unaware of something as basic as customer collateral was combined. That's impossible, literally impossible.
You mentioned Tom Brady and a few other celebrities. A lot of them are now being vilified for having promoted FTX during that time. Of course, their defense, which is, I guess, a fair one, is that they had no idea they were helping a scammer. Should they be held accountable?
No. I mean, and look, as a Jet fan, I would love to be able to vilify Tom Brady, especially because when he spoke at the conference, he vilified the Jets again. But the truth of the matter is, how could they possibly know? Seriously. FTX was able to fool, hell, they fooled me. I'm not going to lie about it. We kind of knew because our clients told us that there were back doors that Alameda had, probably special advantages, but they still all used FTX because of the way they combine collateral and the professionalism of the platform. And so if they fooled us, fooling a football player, I mean, as smart as he might be, doesn't matter. I can't blame him. But I do blame Sam. And I do think that he is at the same level of sociopathy that Bernie Madoff was. I think that in his case, it might even be worse because Madoff knew what he was doing to his sons. And by the way, I was friendly with Mark Madoff, who tried to hire me twice. And so when he killed himself, I felt that. I mean, he was a very nice guy. I don't believe he knew a damn thing. So, but Bernie knew he was doing that. I was friendly with Bernie's brother, and I don't know when he learned about what was going on, but the key point is Bernie, even in prison, admitted and felt remorse. I wonder, I actually don't think Sam feels any remorse. I think his only remorse is that they bet on long instead of short and so got caught.
Right. So ultimately then, based on the facts and the information that you've seen gathered, do you think prosecutors have enough evidence to prove that there was intent to deceive investors, or maybe this was just a big mismanagement of funds?
No one is that stupid. The way that the way that I'm going to title,
well, it's not what we think; it's what we can prove in court, right, Dave?
Right, but the fact of the matter is, it's really hard to prove. In criminal justice, the Latin term is mens rea. That's criminal intent. That's what you're getting at. And To argue you did not have criminal intent when you knew how roughly the size of how much you were marking. I know, for example, here's a great fact for you. I asked specifically Brett Harrison during 2022, long before FTX collapsed, how did the FTX risk system operate and perform on days where there were 15% down days? Because we were discussing why real-time risk is better. And Brett went to Sam, and Sam specifically told him, not, I don't know. He said, it performed great. We lost less than 0.1 basis points of assets and therefore did not have to socialize any losses to our community. Now that I know for a fact. I mean, I'm not angling to be called as a witness, although Brett probably should. But when Sam said that, that means for sure he knew and looked and couldn't claim that Alameda didn't have this black hole, right? The 65 billion that Gary Wang testified about yesterday. Whether Sam knew it was 65 billion or not, I don't know. That's between Gary and let the prosecutors prove that, although I suspect that he did. But he absolutely knew that what was going on inside the risk engine because he was willing to talk about it with precision. And the one thing about Sam is if he says, he often said nothing, but when he said something, he was generally pretty ADD, pretty, hyper focused on that. So there's no way he didn't know. So yes, I absolutely believe prosecutors will be able to prove mens rea, that he knew what was going on.
Maybe the president will pardon him because he is a poster child for entrepreneurship and all that.
I hope not. I mean, that would be one of the worst looks, and that's saying something. That would be one of the worst looks for this administration, to pardon somebody who was one of the single largest donor to his party. I can't imagine there's a single staffer in the White House who wouldn't basically warn that would be something that the electorate just wouldn't accept. So I strongly hope not. But you know what? We've seen so much strange stuff over the last 10 years. I'll never say never to that. But I think it'll be almost impossible for Sam to escape a rather lengthy sentence here without, help from above, as it were.
I want to close on CoinRoutes. So your company provides analytics for the crypto institutional investor and trader, like you mentioned. Do you also have data on just traditional finance, bond yields, stock markets, stuff like that?
Well, we don't do anything on that, but we do a lot of data on crypto that's actually interesting, and I have access to data because I have friends in traditional finance. So one thing I was telling you about before we came on is that there have been some studies that Bloomberg has done, their BTCA, their transaction cost analysis product, and for across their customers, institutional traders of over, institutional trades measured at over $200,000 is how it's measured. The slippage in the United States, U.S. equities, is somewhere around 11 basis points on average for those orders. Slippage meaning the amount that you pay above the midpoint at the time that you get the order. And it's actually between 7 and 9 for smaller size institutional orders in equities and around the world. Well, CoinRoutes, for our client base, on about $13 billion worth of institutional orders, that averages around $2 million per side. We basically gave our customers, or our customers achieved, slippage of somewhere between 7 and 8 basis points, which means that our clients actually traded an asset that's far more volatile and supposedly far less liquid than equities, net cheaper. So, we kind of look at that as a victory. Yeah, it shows that we're doing a good job, but it also shows that crypto is a hyper competitive and maturing market, and one that works far better than the average people think it works. And so that's kind of relevant, but we're always looking at market structure and comparing to other assets.
Okay, perfect. Where can we learn more about you and CoinRoutes?
Well, you can always find us on coinroutes.com. Our website, we're actually in the process of updating it now, so stay tuned. I'm at Dave Weisberger1 on Twitter, and I'm Dave Weisberger on LinkedIn, and at CoinRoutes on Twitter, and I think it's at CoinRoutes on LinkedIn as well. But we're always out there, and we've actually submitted a paper to the Journal of Investing, so we'll talk about that when it's peer review. There may be other things to talk about.
Yeah, that'll be fun. Yeah, you're very active on Twitter, and you're in a lot of Twitter spaces as well. So please go follow Dave on Twitter. Thanks very much for your time today.
Thank you, David.
Thank you for watching. Don't forget to like and subscribe.